Hello, everyone, and thank you so much for joining us today for our coffee series webinar, Sourcing the Best Deals like VU Venture Partners. My name is Dan Polanka. I'm a Senior Product Marketing Manager with Affinity, and I'm excited to be joined by Sky Fernandez. Sky is ranked as a PowerList 100 VC and is the founder and GP of VU Venture Partners. He's also the founder and CEO of Venture University, the world's leading investor accelerator for individuals breaking into venture capital, private equity, and angel investing. Sky, thank you so much for joining us today. How are you doing?
Awesome. Yeah, thanks for having me, Dan.
Absolutely. So as I mentioned, Venture University, sort of frames itself as an investor accelerator, something that's a little bit, not typical for what we think of as an accelerator. So can you provide us with a little background on the university and your philosophy on accelerating investor skill sets?
Yeah, absolutely. So the original creation of Venture University really, I think, came out of the natural evolution of the overall startup investor ecosystem. If you think back to the rise of just venture funds becoming generalist funds, then becoming more vertical focused funds, to then the rise of startup accelerators. First, they were generalist startup accelerators, then vertical focused accelerators. Then you had the rise of incubators. And I think it only made sense that eventually you'd have an evolution of an investor accelerator instead of a startup accelerator, where individuals that are looking at becoming venture capital, private equity, or angel investors have a platform to both learn on the academic side all the core things that you need to learn how to do investing in startups, as well as up through growth equity companies on private equity, but also benefiting from actual work experience, right? By actually joining a venture fund or a private equity fund with VU, focusing on sourcing, doing due diligence, and actually making investments and building a solid track record for yourself that you can use to then go on and either launch your own fund, launch your own syndicate, join other funds. And so similar to like the value of a startup accelerator, where you do it not just for the learning, but you do it to actually accelerate your company during that time, and surrounding yourself with kind of core mentors, and then ending with startup accelerators. They have a demo day where the startups eventually pitch the companies that they're working on in hopes of raising their seed round. With us, instead of having a demo day, what we do is we call it a reverse demo day, where
Okay.
at the end of the program, we do a presentation about the companies that we're investing in. So we basically present our investment thesis for each of the companies that we're investing in during the quarter. So we call it a reverse demo day because it's our investment team pitching the startups opportunities versus the startups presenting. But we do it more from an investor's perspective. So looking at the market size and how we deem it is, looking at the due diligence that we completed, looking at the return profile of the opportunity. So similar to, but different from an investor pitch, from a startup founder pitch, but from a truly kind of internal investor pitch of what we'd be looking at during an investment committee. So it really is designed to allow people to get that experience for 3 months to 12 months. And being able to get out of that, and you'll make somewhere probably between 7 and 30 investments when you're with us for those 3 to 12 months.
Okay. Yeah. Interesting approach. Sounds like it's been effective. Curious to know sort of your typical student profile. Do they come in with any type of investor experience, or how would a profile of a typical student differ from the traditional career path that we might see in a VC or PE?
Sure, yeah, absolutely. So we certainly have a pretty broad audience of people that apply. We get on average, applications wise, we're getting around 5,000 or so plus applications every kind of quarter, which is and out of that, we're pulling about 50 of them that we actually have joined the program. So similar to Y Combinator, which, when it started was about a 1% acceptance rate, we're similar. We're about a 1% acceptance rate into Venture University. The profile of the individuals certainly have pretty strong backgrounds across the board, but what we're looking for is we have 7 core characteristics that really define being extraordinary. And so that could be either extraordinary in your background academically. So a lot of people have gone on to, previously some of the top academic institutions. We have people that have really solid industry experience where they might have been at a company and they became head of, self-driving vehicles at Tesla or something. So if you have true expertise in something, you're going to be uniquely better at sourcing and doing due diligence. Third, you might have already founded a company and exited that company, either successfully or not all that successfully, but you've gone through actually the whole journey. And it might have been a really fun journey around there. They'll give you a lot of lessons about what to look for when investing in companies. And then we look for people that are just really, really good at dynamically thinking and helping to evaluate opportunities. So internally, every quarter, when our admissions team is evaluating the candidates, we have 6 deal sourcing teams. We have the consumer team and the enterprise team are 2 generalist teams, but we also have the fintech team for financial services. We have the frontier team for things like advanced AI, advanced robotics, advanced materials, space tech. We have our healthcare team, and we have our real estate prop tech team. So across those 6 verticals, when candidates are going through the admissions process, our admissions team is helping to figure out who amongst that group is going to be best to be on the fintech team or the healthcare team. And so we're making sure that every team is really stacked with some of the best people possible for sourcing and evaluating opportunities. And so the backgrounds also include people that are really from like their mid 20s all the way up through their kind of like 60s. And another thing that our admissions team does really well is that every cohort is roughly evenly balanced in 25% for every 10 years of age. So people in their 20s, 30s, 40s, and 50s, pretty equally balanced, about 25% by every decade roughly of age. That gives us also a breadth of people that have really strong networks across their history of existing so far in particular verticals. You also have about 50% of every cohort are individuals looking to break in as kind of analysts, associates, principals.
Okay.
And then the other 50% is split between people that are emerging fund managers. About 25% of every cohort are emerging fund managers. Another 10, 15% are angel investors and family offices. And the last pool are people that really are looking to launch their own startup, where they're looking like thinking like an investor. If I can think like an investor, maybe I can go on to create a really big opportunity. And sometimes we have serial founders have recently exited a company, and now they're kind of deciding if they want to launch their own fund, or maybe they want to find another company to start. And so that's core part of like their mission involved in why they're doing VU. And then from a general demographic perspective, every cohort is about 30 to 40% women, and usually about anywhere from 20 to 30% underrepresented minorities. So a big part of what we're focusing on is also changing the face of what venture capital and private equity looks like. We've now graduated a little over 550 people over the last 4 to 5 years, with about a little over around 2/3 roughly of people that are then joining other venture funds and private equity funds. A significantly higher success rate than even if you went to a top business school like Harvard Business School or Stanford, certainly outperforming in your success rate of what you're going to do afterwards if accepted into VU.
That's great, and really, happy to hear that you do have that sort of focus on diversity and inclusion. And definitely sounds like there are some, sort of similarities with what an accelerator might look for in a typical candidate as well. So the founder sort of perspective is interesting to hear. As I mentioned in your intro, obviously there's also a fund related to the university, VU Venture Partners. It'd be interested to hear sort of what the relationship between those two is and how the staff at the fund breaks down in terms of graduates versus external hires, and then for the university, what percentage of graduates, go on to do something outside of that.
Yeah, absolutely. So on the fund side, so VU as an entity really is kind of a core investment platform that has a few things underneath it. So we have our venture fund, VU Venture Partners. We have our private equity fund, VU Capital Partners. We have our investor syndicate, which is called Bonded, which is kind of allowing for people to invest on a deal by deal basis. We have Venture University, the investor accelerator, and we have our fund admin platform that we just built called Finally Fund Admin. So really all that is kind of underneath the overall platform of VU. The connection between Venture University and VU Venture Partners or VU Capital Partners is that the individuals that are accepted into Venture University then get to join an actual venture fund or private equity fund. The split is we have roughly about 80 or so people on our venture team, which is a combination of about 50 to 60 people from Venture University, and the rest are people that are full-time hires within the fund itself.
Okay.
So from an operating perspective, we have the 3 partners. We have myself, Sky, the founder. I've been doing venture capital for about 15 years. My partner, Andrew Zalison, he's been doing venture for about 25, 30 years. And my partner, James, for a little over a decade. So about 45, 50 years of venture experience across the 3 of us. Together, we've now invested in a little over 20 unicorns. So we were some of the earliest and largest investors in those companies. So my partner Andrew, for example, was in the Series A round of Facebook. There's a very short number of investors that are that early on the cap table of the Series A. Also, companies like Uber, coming in at $1 billion, exiting at 40 billion, so you're making a 40x. First check into Venmo with the first $250,000. And then James, being one of the co-founders of Formation 8, now 8 VC, incubated internally companies like Palantir and Wish. And on my side, I've done a lot more of the consumer stuff. So like one of my biggest exits was Beyond Meat, a plant-based protein, product that a lot of people now know. It's sold in most grocery stores and a lot of restaurants. But I was the largest investor in the company, served on the board, and that exited, returned a little bit more than 2 times my entire fund, going from up to a max of about $14 billion valuation. So what's great about joining venture universities, you get the experience to learn from case studies of all of these great companies. And even our own fund at VU Venture Partners already is directionally about 5 to 7% of our portfolio have become unicorns. And by probably 2023, we might even have almost 10% of our portfolio where we're investing at the seed Series A stage are becoming unicorns. So truly outperforming, and you get to benefit from being part of that experience in how we go through our unique process in sourcing, doing due diligence, and getting into these companies that are some of the best in the entire venture asset class that we're getting into. So you get to benefit from that overall infrastructure that we built in joining a top tier fund to help build out your own track record.
That's amazing. Congrats on those big wins. We are beyond household, so excited to hear about your
Awesome.
involvement in that. Obviously one of the things that goes into that track record is sort of the success that you have when it comes to sourcing deals. I know on the the fund's website you talk about how you typically source around 20,000 deals a year, which is about a 10x multiple on the average $100 million VC fund. So can you sort of share with us some of the key factors that contribute to those levels?
Yeah, absolutely. So the venture asset class is a fun one in a number of respects. And fun, not in the positive way, but the fact of more how challenging it is. If you look at the volume of deal flow that exists in the venture asset class, it's significantly larger, obviously, than private equity. And as you go downstream to kind of pre-seed, seed, Series A, Series B, that's where the vast majority of venture deal flow exists. As you get into Series C plus rounds, the volume of deal flow is a much, much smaller pool of companies to evaluate. Roughly about 90% actually of venture deal flow is pre-seed through Series B. 10% of the deal flow is Series C plus. And to put it in perspective, there's about globally companies that are raising capital are about 300,000 companies globally that are raising capital a year. As you narrow that down to the companies that actually successfully raise any round of financing that are going out to raise, you're getting down to about 100,000 or so companies. And so when you get to where we're now doing about 20,000 companies a year, we're looking at about 1 in 5 companies globally that actually close a round of financing. And then as you go down to actually, we're not focusing on, for the most part, Series C plus. We're in that pre-seed Series B stage. So our volume deals is closer to about 80 to 90,000 or so that we're actually are our core targets. So we're looking at definitely, we're not aware of any other venture fund in the world that's evaluating more volume of deal flow than we're looking at. When in terms of a team size, companies like Andreessen Horowitz, NEA, Kleiner, Andreessen has 190 plus people on their team. Andreessen has about 50 people on their investment team, but a good portion of their deals that they're doing are significantly later stage than Series B. So where we're kind of really unique in our sense is focusing on that pre-seed through Series B with the largest deal team to be able to do that by combining Venture University with our full-time investment team. It's the only way you can actually mathematically support having the human capital to effectively evaluate that number of deals. And the way that we get to it is roughly going after 5,000 deals a quarter. We have our US team and we have our Asia team, and then also a European team. So 3 kind of global teams that are evaluating all of the deal flow. The way that we do that is initially we look at narrowing it down to the first about top 3,000 of companies that have raised capital between the last 12 to 14 months, knowing that companies typically will raise every 12 to 18 months or so after they close their previous round. So at least we're going after like the highest candidates there. Plus, we're adding on our own data layer of companies that not only closed financing round 12 to 14 months ago, but who were their investors. So we have kind of our own hit list of angel investors that we know typically have had really great performance as an angel, or if they went through certain accelerators or certain other seed funds. So we're kind of adding our own layering on top of that of who has really great or consistent returns from the past. And then we have a number of other channels that we're doing. Certainly, we build our own market landscapes. So every time we're looking into a deal, we're evaluating who else is in the overall space, what are the sub verticals of that space. We try to meet with as many companies as we can. For example, after my investment Beyond Meat, we have a lot of companies that we've invested in now in the future of lab growing muscle and fat and other aspects of lab growing, not just plant-based. We probably met with about 50 plus companies in the overall space of kind of the future of lab growing food. So we go really deep in intelligence when it comes to that. And then we probably something that I'm surprised doesn't happen more often is we've instituted a quarterly deal flow call with a large number of funds. So we kind of picked our top 20 generalist funds, our top 10 to 20 healthcare funds, fintech funds, prop tech funds. And so we do a quarterly deal flow call with all of them. I think we're at about 70 or so of those funds that we do quarterly deal flow calls with. Similarly, we do accelerators. I think with accelerators, in some cases we're meeting with the founders well before demo day happens, and kind of doing a month or so in advance before demo day is happening. Other times we do private pitches at our office or virtually, where we'll set up like 3 tracks of virtual conference rooms where we'll get through an entire accelerators class within about 3 hours with 3 different tracks of investors we're evaluating. But it is a big part of it is really human capital engineering to make sure that you can actually get through the deal flow. Now, I'm not going to say that getting through all of YC's companies is proprietary deal flow, because it's not. But there is a thing of proprietary effort, which is like, did you go through all 150 companies and then pick the top 20 of them to then schedule meetings with? Because we do that every class that YC has, 500 has, Plug and Play has. And so it is a pretty big effort involved in tracking that. And one of the things that we saw early on, about I guess now close to 5 years ago, given that we're looking at 20,000 a year, your initial starting place is like use Excel to track deal flow. The worst thing that could happen, and it happened a few times in the first year, is you have an analyst who sorts the giant Excel sheet of deal flow and screws the whole thing up. So the same data isn't in the same row. And you're like, there has to be a better way. And that's actually when we ended up reaching out to looking at some of the overall platforms for tracking our deal flow. And Affinity by far was the best option for us, not only in the capability as a database for doing that, but also that every team, like our healthcare team, could have its own view of just the healthcare deals. The fintech team could have its own view of fintech deals. And it had the CRM capability. And for us, given that we have such a massive team and also a group of those individuals that are changing every 3 to 12 months, knowing the prior communications that have happened with startups is extremely important. So the combination of that CRM value plus the being more of a database true approach for deal flow management is ultimately why we ended up going with Affinity. I think we were like venture fund number 750. I think we got when we joined. So obviously well established already, been getting a good portion of the market already, but it has been great for us, and we've been loving using it ever since.
Well, very happy to hear that, and obviously we're very happy to have you guys as customers as well. And thank you for that, very comprehensive overview of a very comprehensive program and sort of strategy. I am curious, with sort of a different profile for your students or your investors coming in. Are there any key lessons outside of what we've already talked about that you sort of look to instill in them that may be lacking from a typical VC's workflow, or anything that you ask them to sort of stay away from or have caution around that would be typical?
Sure. Yeah, I think that there's a few things I think that you can only really get probably from experience and not from the academic learnings. A few things. One is that when we look at capital efficiency of companies, I think we have a different approach than just the mere LTV to CAC capital efficiency. So internally, people have started calling it the Sky capital efficiency ratio, because I kind of created my own modified ratio for doing that. But We
Okay.
look at current annual run rate of revenue compared to the amount of capital spent specifically on scaling the business. So basically say how much capital has the company raised, how much has the company spent. Of the capital spent, if you were to give that a breakout between spent on building versus spent on everything other than building, we take that amount you spent on everything other than building and compare it to your ARR, and it's kind of a good no BS answer of your actual capital efficiency. And we can look at, based on your projections and with this upcoming financing round, are you looking at maintaining, increasing, or decreasing that capital efficiency? And it just gets to the chase a lot faster than LTV to CAC is oftentimes something that founders like to quote, investors like to focus on, but there's a lot that you can have a positive LTV to CAC ratio and completely be a failed business still. And so the getting out from all the hidden aspects of LTV to CAC is one thing that we focus on. The other big one that I think is slightly maybe controversial, but I think is based on much more superior logic, is between my partner Andrew and I. We share kind of a perspective of, the two most important things when evaluating a company are team and market. But I think the actual understanding of those two is something that really doesn't go into deep of how does one actually in detail evaluate team, and actually thinking about market. What are some of the core nuances in evaluating market, and that if you had to pick between team and market, why we fundamentally believe that market is more important than team, at least in venture capital, which is different than in private equity. But we have a whole framework. I'm happy to kind of go over more detail about how we do that. But there's some core important nuances that only I think if you're really talking to some of the people that have been doing venture capital for many decades, you get to some of these core truths in how to really evaluate markets, and also why it's a lot more important than team. Team still, I would still say, solid number two, but there's a good amount of superior logic involved. If you want me to go over that, happy to kind of give you the high level overview of that.
Absolutely. Yeah, I know that when we spoke previously, you'd mentioned this sort of philosophy, and from my perspective, some of our viewers today might, not be in full agreement with that, or not be used to hearing that necessarily. So yeah, we'd love to hear some of your logic behind that.
Yeah, so I'll give some good frameworks that I think hopefully by the end of the framework, you'll come to a similar conclusion, because I do think it is pretty close to infallible logic. So a few things. So I think if you were to ask the average MBA student what's the most important thing in evaluating a company, they'll give you team, which is definitely a very good ego answer for an MBA student to give you.
Mhm.
Most of them are looking to go on to join large corporations and trying to become the presidents, be ladder climbers within those organizations. I would say if you're going after a company that's already large, like a public company, or a large, S&P 500 company in general, it's basically don't screw up, right? You already have product market validations already there, revenue profits already there. So I agree with private equity and later stage stuff. I'll 100% agree that team is probably the number one thing. But for venture, I definitely don't think it is. So I'm going to kind of give the framework of why I would say market is superior to team from a venture perspective. So one is that if you had the best team in the world going after a small or medium-sized market, you will never be acquired for a really large amount of money. That's one core part of the logic. So again, best team in the world. You could have the who's who of everybody. If the market's small or even medium, the market's not big enough to ultimately get to really large enough revenues to be worth, close to even $1 billion or more. So that's one that I think is a really hard one to break. Two is that if you look at the difference in skill, the range of skill capabilities of the average human versus actually the spectrum of the size of market size, I think it's an underappreciated point of actually how massive markets can be versus how small markets can be versus the best capabilities of someone's human execution capability.
Okay.
So the difference between a company worth $100 million, which is still like a decent exit, you invested at 10 million and exited 100 million. Prior to dilution, you're making a 10x.
Mhm.
But a valuation of $1 trillion, we now have a handful of companies that have hit $1 trillion valuation. But if you were to kind of think of the full spectrum of what a company could be worth, of hopefully at least 100 million up to, certainly a billion, 100 billion, but $1 trillion, is a 10,000 times difference. And I would argue that no matter how great your team is, their capability of executing is not 10,000 times different. I'd say maybe about 100 times different, but I'm not sure 10,000 times different in people's best ability to execute. And so the impact of what your final valuation could even become will be much more greatly impacted by the size of the market capability than your ability to execute. The third point I would say is why, if it was all about execution, which it's not, if it was all about execution, then how do you get companies in venture that are pre-revenue and pre-product to get acquired for a few hundred million or a billion?
Mhm.
How much execution happened if it's pre-revenue, pre-product? And why did they even get acquired for 100 million to a billion pre-revenue, pre-product? Was it because their team was so amazing for the lack of execution that they've even done so far? It's because of the market size opportunity that they were going after. So if you take examples like we have a company in our portfolio, Bear Flags Automation. John Deere bought it for 250 million about 14 months after we invested. We invested at about a $27 million valuation and made it a 10x or almost a 10x in 14 months. Why did John Deere, big tractor company, buy an autonomous driving tractor company for 250 million? Why not 50 million? Why not 100 million? It was pre-revenue, pre-product. And it really came down to what John Deere felt that the future market size opportunity could be on that, and buying it for 250 was nothing. Same logic actually happened for Cruise Automation when
Okay.
GM bought Cruise for $1 billion 18 months after it launched. Right, it was Cruise was pre-revenue, pre-product. GM bought it for $1 billion. Why not buy it for 100 million or 200 million? Why a billion? It ultimately comes down to what the market size opportunity is. So if you have a really, really big market in front of you, acquirers and even public markets will significantly increase the valuation they're willing to pay you because there's a much bigger market for them to grow into. If they bought you when you kind of had peaked or matured in your overall market already, you're not going to get the biggest acquisition offer, no matter how great your team is.
Sure.
But if the market's a lot bigger and they can like grow into that by 10 to 100x more after buying you, there's a much better argument for why they're going to pay a lot of money for you. So the final outcome of what the final exit size will be is going to be much more based on the size of the market than how great the team is, and even if they haven't even executed anything.
Mhm.
I think when you take all that into consideration, from a venture perspective, I have to go with market over team. But it ultimately does go back to if you had to choose between an A market and a B team, or a team and a B market, I would always go with the A market first. And you can just be a mediocre founder and actually be going after a big thing and have a quick or relatively large exit for that. So it's again a different game, I think, for venture capital than private equity.
Sure.
I would say that valuing team is also something that is very squishy, and we've kind of come up with a few non-squishy ways of evaluating team. Typically, does come down to the ability to sell and execute. But no matter how great they're at it, it'll always be dwarfed by actually the overall opportunity that they're going after. Otherwise they're going to have to pivot, and if you pivot into a new market, it can be good for you or disastrous. But the last thing I would say about kind of fun framework thinking is if you organize it between market, team, and product strategy, it's also in the order of which is the hardest to change to the easiest to change. You can't change the number of people that are actually your target demographic. There's only a certain number of
Sure.
humans that exist or
Mhm.
enterprises that exist. You can certainly create something that's going to be more likely to be adopted by that demographic, but you can't change the number of people. And so all you can do is pivot to a completely new market or demographic. So good luck on trying to actually change the core size of the market. Now, there are companies that can expand the size of a market. Those are certainly possible. That's really making something that's more adoptable by the same demographic. The team, you can definitely change the team, but it's painful to change the team, but you can definitely change it. And the product strategy is the easiest to change. When you have a great team, you can pivot to a new product strategy. So I'd kind of add those are some of the core elements that I would say of a framework. And one of the more recently, there was before Don Valentine from Sequoia passed away. He gave a great talk at Stanford Business School, and some of the elements that I just said, not all of them, but some of them he brought up in his one of his last speeches that he gave about why Sequoia also focuses on market over team.
Mhm.
And I think when we've now done, I want to say close to 250 plus fireside chats with VCs. One of the interesting things, if you interview younger VCs and you ask them which is more important, almost all of them will say team. And if you interview the people that have been doing venture for 1 or 2 decades, they almost all say market. So it's an interesting perspective on feedback. There's always the few exceptions to that, but in general, you start seeing the shift in the response when experience is actually weighed in.
I think that that makes a lot of sense, especially in terms of, sort of minimizing risk and maximizing returns, which is probably the most important thing. I have a lot of questions off the back of that. I think maybe one of the things I'll start with, you mentioned sort of non-squishy ways of evaluating teams. I know you have a standardized process for, sort of how you filter and evaluate investments in general. Can you sort of give us a little bit more detail around that?
Yeah, absolutely. So I'm a big fan in creating frameworks that I can use as well as the people that are part of Venture University and our team to try to create some consistency in how we evaluate. And my first like 3 years of venture, one of the things I realized is that I started meeting with like 3 to 5, sometimes even 8 startups a day, but typically it's about 3 to 5 startups a day. And when I get to like the third, fourth company, I'd always realize that I would sometimes forget if I asked this company that question or I asked the prior company that question. Like it starts kind of blurring together a bit. And I wanted a consistent way to make sure I was always asking some of the best questions one could ask about evaluating a startup, and make sure all my core areas of evaluation were covered. So after about 3 years in, I created my own investment evaluation sheet, which has 12 core sections of criteria. And within each of those 12 sections, there's key questions that I have. So things around market is the first one. So I have multiple questions around market that we ask. We have problem, solution, team, all the way through revenue model, main key risks, main time, efforts, and expenses, exit thoughts, things like that. We've got 12 of those. And over the years, I've continued to improve on the core questions that I ask within each of those sections. So we've developed this investment evaluation sheet. We've made it public for any other venture fund or entrepreneur to use. And there's actually a good amount of angel groups that now have adopted this investment evaluation sheet, and some other venture funds that have started using it over the years as well. But I've continued to improve that over the time as I get kind of a new core question to ask. I add it to that overall section, and it's not designed to be robotic by any means. So you don't necessarily have to get answers on every section or get answers to every single one of those questions. But sometimes you're kind of looking for additional questions to ask that you haven't yet asked, and this will definitely be making sure you're covering all the core things. We then use that investment evaluation sheet, and we use it for preparation for the partner meetings that we have on every Monday. And so if you do a good job on answering that, it should be pretty easy to prepare for the partners meeting, because all the
Mhm.
the core questions are the same ones that we bring up during partner meetings. And it also acts as a core resource document to eventually draft up your presentation for an investment committee. And it's a document that it's a living document, keep on adding to it with your second, third, fourth meeting with a company. But I found that was definitely one of the fastest ways, as we've now onboarded cohort members, to be able to immediately be collecting core data. Because one of the questions you might ask is, well, if you have these people that have never done venture capital before, how do they even know what questions to ask? And they're all really intelligent people to even get into Venture University, but they certainly don't have the experience in evaluating a lot of companies from the past. So this kind of guidelines allow them to effectively collect data. And the challenge of the venture industry, one of the many, is the fact that all this data is not public. So it is a human-intensive process to actually collect data, kind of turn it into information, and then be able to reflect on it during partner meetings and investment committees through knowledge and experience. And so that's a resource that I know that we spoke about before. I'm going to be sharing the link for everybody that's watching this webinar, that if they would like to download the investment evaluation sheet, we'll be able to provide that for them.
That's great, and I'm sure that'll be very appreciated. I'm excited to see it myself and do a little bit of a deep dive. I want to switch a little bit to, just the idea of technology and how that plays a role in your world and across the university as well. So, obviously, as we spoke about, we're proud to call, your team a partner, a customer here at Affinity. Can you tell us a little bit more about what life was like before Affinity and how your team now uses the platform to drive deals?
Yeah, absolutely. So for sure, I don't think we could have scaled as a fund without Affinity. I think that would have been pretty much impossible. It just there would have been too many pain points of an Excel Google sheet, not eventually getting screwed up. It also doesn't have the easy ability to consistently track on a CRM basis for engagement with each of those deals. So for us, that's been a game changer. Also, given that we just have such a massive team, and the need for viewing deal flow differently depending on the team that they're on, as well as the people that are with us for 3 to 12 months, being able to have that cycling of individuals, but not losing the intelligence that happened along the way. We certainly could have never scaled without it. So it's a pretty critical part for how we operate as a fund. It's also something that we certainly recommend for all the individuals that are doing VU, that are going on and launching their own funds. They're going to face similar issues, and so we kind of getting them used to using Affinity makes it easy for them to bring it on to where the new funds that they're either joining or launching afterwards. But yeah, definitely, our life would be significantly more painful if we didn't have Affinity.
That's great. I mean, it's great that it's less painful now, I should say. And then are there ways that you've been able to, sort of integrate the investment evaluation sheet you talked about into the platform?
Yeah, so yes, so actually one of the things that we do now during partner meetings is that we've added columns next to each deal in terms of adding the calculation for market size, where we actually don't allow anyone to present a deal during partners meeting if they have not actually filled out the market size calculation themselves. So it is unacceptable at VU to present an opportunity and you say that the company has a $50 billion target market because that's what the company told you it was. You can't do that. And so you actually have to do your own calculation of the true target market of that company, which is a pretty simple calculation, but we added the columns in Affinity that people fill out, which is what is the target number of potential customers based on the demographic of who their customer is, multiplied by the average revenue per customer, will give you the actual SAM. We try not to do TAMs because it's more of a global number, but a SAM,
Okay.
a serviceable addressable market for the true market that the company is going after geographically. And so, yeah, we use that. Very important for us they have to fill that out to actually present it during a partners meeting. The end result is that every quarter we can actually then sort by the largest market opportunities that we've evaluated over the last quarter, which is an interesting thing to reflect on. And you really see that huge spectrum of, like, we're investing in a company. We had an investment committee yesterday that we just approved our next investment in, which I won't say what company it is yet, but that company, for example, has anywhere between 600 billion to over $1 trillion market size. But that was supported by the math that we did in evaluating the company. And so to knowing that that's like theoretically what you could have going forward for an opportunity is massive. And sometimes you're certainly going after markets where it's a little blurry on truly what the future market size is, and it could be bigger than you could ever even calculate, which is not necessarily a bad thing. But there's a big risk difference between being able to calculate a market that's large now versus only large in the future. And being wrong on market timing is definitely the same thing as being wrong.
Well, I'm glad to hear that you are getting value out of using the platform to do some of your own calculations. I hope the enriched data that we provide is also providing you guys some insights into those deals. Obviously, one of the biggest sources of information that you have when you're evaluating companies is speaking directly to founders. I understand that your team is currently working on sort of some proprietary tech that uses AI to, I might be oversimplifying this, but sort of automate founder meetings. So can you sort of tell us a little bit about what you're working on, some of the use cases that goes into?
Yeah, so we're working with a company. We're partially kind of incubating them internally, and we're looking at how we can use AI to facilitate kind of an increase in scalability as a venture fund, because that's a core thesis as a fund overall for us is to be highly scalable. So there's a few core features that have been built out around this. So one is that in all of the meetings that we're doing with founders, being able to have all of those meetings recorded, transformed into a transcript, and then using an AI chatbot, being able to ask it any question from any meeting that we've had with a company. So for example, if you said, hey, what was so-and-so's company's revenue projections in year 5, or what's their current revenues? Hopefully you took the note when you were in the meeting, but you might not have. Or maybe you're presenting at a partner meeting or IC, but you weren't part of the original meeting. You can still have access to all the notes from all meetings that have ever happened with that company. So being able to query that from an AI chat conversation that can query all previous meetings across the team is a pretty interesting feature. Two is being able to, from Venture University's perspective, we've now, of the master class that we teach and the advanced modules, we've now had 28 cohorts. Each of it's about 250 slides for the master class. So every one of those 250 slides I've taught 28 times, and there's been questions around every single slide. So if you take all of the Zoom video recordings of all 28 times I've taught the master class, and you transform that into an AI chatbot where anybody could basically ask me any question on anything on venture capital and private equity and receive a paraphrased response on something that's similar to what I may have said in the past. Again, you have 28 times for every one of those slides. It's an interesting database of paraphrasing answers. And so far, the demo that we've done of it so far, the demos have looked pretty extraordinary for how well it's able to paraphrase on core content of what's been said in the past. And then the third part of how we're looking to use it, which is a little bit more of an advanced feature, is the ability for any founder to be able to pitch us and be able to basically pitch my personal AI prior to actually meeting with us. And it would ask the same questions that I would typically ask. You present just like you normally present as a founder. So you bring up your slides, you verbally present. And my personal AI will just ask questions that seem relevant based on the slides that you've just presented, which are pretty similar to what most founders are presenting on, their market slide and their team slide. And so the output of doing that is almost like a way for founders to prep. Like, how do you do an investor prep before ever meeting with any investor? This is going to be a great platform for founders to be able to do that and be able to hear and answer the questions that I would typically ask, and get the output where you have kind of a summarized transcript of all of the core answers to those core questions, which can then be shared with any other venture fund afterwards. So we're trying to create it as a resource benefit for founders, but also a way that we're never limited in saying, oh, how do I get access to that fund so I could potentially pitch them? We'll basically be able to have any company in the world will be able to pitch us, and then we can evaluate the data on a weekly basis and then see which ones we want to do as a second meeting that'll be more of a human meeting versus the AI initial meeting, is the plan. So again, it allows me to basically go from where we're evaluating 20,000 companies, but I'm usually going into a lot of the second meetings, not a lot of the first meetings when we do evaluate companies initially. Now everyone will basically be able to pitch me, and I could do 100 meetings in an hour plus. So it's an interesting aspect of how we're developing that, and I think it's a platform that a lot of other companies, venture funds and non-venture funds, will be able to use for just a pretty endless kind of use cases, using this concept of a personal AI.
Yeah, that is super impressive, and the implications of it are massive. And I love the idea of having it be sort of an enablement source, both for founders and investors as well. So really cool. I'll be excited to see, sort of how that evolves. From your perspective, obviously using Affinity and having this technology sort of, being built up. Where do you see the two sort of meshing? How do you see what you're working on integrating into your Affinity workflow?
Yeah, but I should just, I was thinking before last thing, if interested, I think I can actually talk to the company about giving the audience here actually pre-access to even play with chatting with the personal AI, if that is of interest, just to being able to kind of demo it and have a conversation with me. I think we should be able to make that live relatively shortly, so we could include that in the link to share with everybody.
Absolutely.
So repeat the last question again.
Just the idea of how you could take your AI technology and integrate it into your Affinity workflow to get value for your team.
We've thought about this already. So one of the things that we've been testing with is, could you take everything from the transcript and convert it into filling out the investment evaluation sheet, and or filling out the fields that we have within Affinity? And so that's something that kind of an auto input looks possible. The initial layering will be for tags, where every sentence of every transcript is tagged with one of the 12 criteria. So if that sentence seems like it relates to market or team or problem, solution, exit, every sentence is tagged by criteria. And then also we could also take the questions within each of those 12 criteria and tag each sentence to see if it relates to that question. So then in preparatory for a partners meeting or investment committee, you could just click the tags and it'll only show you the parts of the conversation that directly tie to what you're wanting to look at the notes on. So that seems to be the easiest initial way is being able to create a form factor that would take that and either input it into Affinity on its own, and or be able to fill out an investment evaluation sheet, but at a bare minimum, being able to internal of the platform, being able to click a tag and then just see the sentences that relate to that.
That's great. We love seeing how our customers are sort of integrating their own proprietary solutions into the platform. So as that gets built out, make sure you're talking to our solutions engineers. They love making sure that those things are running smoothly and getting as much value as possible for you. So we'll be excited to see that. I know we are coming up on time, so I just want to thank you so much for just this, extremely insightful conversation. Outside of the resources that you've generously provided or are willing to provide to our viewers today, is there anything on the horizon or anything that you wanted to mention before we wrap up?
Yeah, I would say new things that we haven't started marketing yet, but platforms that we've now built and we're going to start sharing with the general public more. One is our investor syndicate is bonded.capital, where investors that just want to invest on a deal by deal basis, and if they have things that they specifically like investing in, like healthcare, we have bonded by healthcare, we have bonded by fintech, bonded by Latin America. So you can basically pick the type of things that you want to invest in. Could be investing in real estate, investing in growth equity, investing in pre-IPO opportunities. You basically pick all the criteria that you're looking to invest in, and then you'll only receive those particular types of opportunities from us that are being invested in by our venture fund or our private equity fund. So bonded, we're going to start marketing where people can join the investor syndicate. And then two is that we just launched our own fund admin platform called Finally Fund Admin. It is kind of a true new product that's never quite existed in the industry. For fund admin solutions, there are basically two options previously. It was getting an external third-party fund admin solution, whether it be like a Carta, an Assure, an AngelList, allocations.com, or you would just bring all of your fund admin in-house. But bringing it in-house is a complicated thing to do and can't usually be done all that fast. And so we want to figure out, is there a way that we can actually create a whole new category in fund admin? So we built this hybrid between an internal fund admin and an external support. And it basically allows you to now have truly one of the lowest cost option for creating fund entities and SPVs, but also giving you the best customer experience. And sadly, as one of the most scaled venture funds, we're also, I think, probably one of the largest investor syndicates in the country. We've gone through the pains of working with prior fund admin platforms, and it's hard. It's very rare to ever find a fund manager that actually likes their fund admin. And so we were like, finally, we could create a fund admin that people don't hate. And that's kind of how we came up with the name for Finally. It was really to kind of be made by fund managers for fund managers. Not only will beat you on price, but will also win based on really high quality customer experience, and a number of factors that we did that by also helping to bring it in-house, than making it a pure external fund admin platform. So we already started onboarding a handful of fund managers that have learned about it just through our internal circles,
Sure.
but getting a significant amount of demand for that. So definitely, if anyone's interested in launching an SPV or a fund, to definitely check out finallyfundadmin.com. There's also calculators on there where you can get a real-time accurate quote of what it would cost for an SPV or a fund. But exciting to be launching those two new parts of the overall VU platform.
That's great. I'll be checking it out as well. So you said finallyfundadmin.com.
Yep.
And then obviously
bonded.capital is www.bonded.capital is the investor syndicate platform.
Bonded.capital. Great. And then if you want to learn more about the university or connect with Sky and his team, you can go to venture.university or vuventurepartners.com, correct?
Yep, perfect.
Excellent. Well, Sky, thank you again. This has been great. I also want to quickly mention that Affinity Pathfinder is now available and is a great sourcing tool for our customers, built to reduce the time it takes to find deals by delivering relationship intelligence and business insights on companies both within and outside of your network. And it provides a great connection back to your CRM from any website and within your email. So be sure to check that out along with our recently released investment sourcing guide, a lot of great tips and insights there. We'll be sure that you're able to get those, Sky. And for our audience, if you want to learn more about that, you can just head to affinity.co. So thanks again, Sky, and thank you to our viewers, and have a great day.
Cool. Thanks, Dan. Thanks, everyone.
Thanks. Take care.